Hey, folks, welcome to a Friday edition of Money and Politics, and I'm glad you're joining me. Before I go too far in, I always forget to say if you haven't subscribed, please consider subscribing. I want to cover a couple of things now that the storm has passed us, and I want to remind you of something we talked about real quick before. This is what I was saying could go wrong. You can read it, and we still have China attacks Taiwan. Won't happen if it does happen till after the Olympics. I certainly hope that does not happen. We shall see. Putin invades Ukraine, could happen. Iran issue, there's a variety of them could go wrong. A terrorist attack, that's been quiet for a while, but now that we're out of Afghanistan, who knows? Rising interest rates certainly is an issue, and the corollary of that is inflation. So inflation is going to help some people. It's going to hurt a lot of people. If you got a home, it's probably going to bring the value of your home up somewhat, but that'll be offset by rising interest rates, which will dampen home prices. And then, of course, if we got more COVID lockdowns, I hope that we are finally turned the corner on that and that we're moving out of there. And what could go right? China doesn't attack, Putin doesn't attack, nothing happens with Iran or terrorism. Interest rates go up, which they will, but that's going up slightly. If you have money sitting around, some people, older people have money in CDs and all, interest rates going up would be good. I remember back in the early 90s, it used to be quite common that people could get 10% interest on their money. So that would help people who want to earn fixed incomes. The COVID lockdowns end. I think that'll happen and we get global recovery. Global recovery is going to help in both oil and in things like hospitality. So look at some of the hospitality names. I think there's some indexes. There's probably an index for everything, an ETF, I should say, on hospitality. I have followed over the last 2 years Norwegian cruise lines. I've never even been on a cruise, really never had much of a desire to. But Norwegian cruise lines has been bouncing up and down. When I first started following it in 2020 in the wake of COVID, and I didn't think COVID was going to last this long, we were getting prices down in the teens on Norwegian cruise lines, NCLH. And I'm just curious because I haven't checked that today. Here's where we are on that, Norwegian cruise lines. And let me bring that up. So that's a one-day chart. The 5-day chart, you can see we were just recently, I got to lean in here, close to $22 within the last 5 days. Every $2 at this point is a 10% move. Here is 1 month, and you can certainly see the choppiness as different news of Omicron. I was surprised that it fell down this low. Anyway, if you want to follow that, I won't spend a whole lot of time on it. If you want to follow that, or you could check out some of the other names, go ahead and do that in the cruise lines. It's anyway, I'm going to leave that. Looking really quickly today at Humble, we have almost no movement, very slight movement. And we had, by the way, the NASDAQ was up and down and ended up at one point up 1.58%. And the S&P was up about 0.5%, and the Dow barely down. So it's a bit of a mixed market. We did have 10 million shares traded on Humble. And again, I'm going to call that a draw. I mean, you can just see how many ups and downs we had with a bit of a sell-off. Not surprising that it would sell off on a Friday. People don't want to necessarily leave their money in on a Friday afternoon. Here's a 5-day chart and a 1-month chart. So we're going to have the earnings. I don't have the time, but I would expect it's been almost 3 months since we had the third quarter earnings, so I think we're going to get between about the St. Valentine's Day and the end of the month. I think we'll get another move on Humble, and as I talked about, that's what we want to get up to speed on that. Also, InMode, which has been down a lot of late over the last 3 months or so, has really been a buy, I think. And you can see where it is right now, 1 day and 5 days. InMode coming out on February 10. I'm taping this on the 4th. So I believe that's Thursday. Expecting good things on that. Now Yahoo is saying, let me get rid of this little thing here. Down in the lower left, it says overvalued. We'll see. I'm looking at this as I say, multi-year hold. And I was just looking at something where somebody was saying on a YouTube video that he bought, I think it was Amazon. He said, in praise of buy and hold, because the stupidest thing he said he ever did is he had bought Amazon at very low at about $12 or so, and the dumbest thing he ever did was sell it. And that, while he made a lot of money, it cost him a fortune. Speaking of Amazon, and here you can see, just shot up after blowout numbers. Up $375, 13.5%, creating a hell of a lot of one-day wealth. And here's the deal. It just fell out of bed the other day, was down to $2,700. I almost bought it, $2,700. And don't forget, folks, you can buy fractional shares. And when it goes up, as it did today, 13%, you're going to participate in that growth of 13%. You don't have to have $3,000 to go out and buy a share of Amazon. Well, you do have to buy a whole share, but you could go out with a fractional share. It could be with a quarter of a share, let's say, which would be approximately $800 if you wanted to put $800 to use toward Amazon. I personally have never owned Amazon. And funny, just because so many years, until really about the last 6 or so, maybe the last 10, it just wasn't making money. But obviously it was a big gainer today, and has been big gainer. And then we have, if I can get this, the other big news on big tech was in the drop-off, severe drop-off of Facebook, now called Meta, but I'm still going to call it Facebook. That's what you know it as. So here's Facebook, and you see today ended down, I would say pretty much marginally, but just had a tremendous sell-off, went off a cliff, and that you can see, that's going off a cliff. Because it had its users going down, and they're questioning some of the future earnings. I was listening to an analyst who has been following Amazon a lot. He said, buy Amazon. He also said on Facebook, he said at this price, and again, where was it just the other day? It was recently just at $350. Here it was on Wednesday, $323. So down almost $90 from where it was on Wednesday. And this is obviously Friday as I'm recording this. He thought maybe at this price, if you want to stick your toe in the water, so to speak, you could do that. The one thing I wanted to share with you, when we talk about this happening to Facebook, and that's certainly a big company, I wanted to talk about a couple things. So let's look at that fall off the cliff right there on Facebook, and I'm going to contrast that to going up a cliff, falling off a bit of a cliff, but then look how it just shot up, and this is on Amazon. And in both cases, this brings up an issue that I want to remind you I have talked about before, and that is you have, when you're investing in a single company, you have what I call a one company risk. So that when you are in, by contrast, some of the indexes I have told you about, and I'm talking because, again, I've started for talking to beginners here. And I want to say, when I'm talking about some of these indexes, whether it's UPRO for the S&P 500, 3 times leverage, or the TQQ, which is 3 times leverage, those you have, and some people said I shouldn't be telling you about that because it's too dangerous. Well, here you are diversified. Here you have, this is the this is the NASDAQ 100 3 times leveraged ETFs. So it's a 3x version of the NASDAQ 100, NASDAQ 100 companies. So you can see that when we look at a year, this has been, until we had a sell-off in the fall, but and it was actually a tough year. It actually underperformed the S&P 500, which almost never happens. But when we look at 5 years, you can see, and put it in better context, long term, this is a great way to have some diversified money. And because it just recently split, you can have this now for $58. I would say I would put money into this if you're willing to hold on to it, for 3 to 5 years. If you have a huge gain in it, you don't have to get out of it, but you can take some money here and there off the table. Remember, over 50 years, this is the S&P, and I use that, I don't have a 50-year chart on the NASDAQ, but this is the S&P, which means we're going to be going up over time. And so that is why I would encourage you, if you take the long look, and the TQQQ and the UPRO are both 2 ways that you can be putting that money in a diversified portfolio. And we've talked about this before. If you want to open up an account for your kids, a custodial account, they're maybe 2, 3, 5 years old, and you can put $58, folks, and no commissions. Just buy 1 share, buy 2, 3 shares. And when the market's gone down, as it has for the TQQ, again, let's look at the last 6 months, and you can see how we went down over the last 6 months from a high up here, actually going back to around the middle of November, and that was close to $90, 88.57. And this is adjusted. These prices are all adjusted because it's split in January, 2 for 1. So that's another thing. Had you bought it, you would have had now twice. If you'd have bought 3 shares before, you'd have had 6 shares now. But when it goes down, that's when you want to buy. You don't want to buy it when it's up high. You want to buy it low. Obviously, buy low, sell high is the name of the game. So when it goes down, as it has somewhat, and it's a diversified, there you go. That's one of the great things I think that you can buy if you are going to be a long-term holder. If you want to play short game, good luck to you. Now, let me talk briefly about the short game. And I say, yes, by the way, let me finish that thought. When you buy one company, even something like Facebook, we see how it can fall out of bed. And then you think you're safe, and all of a sudden your money falls $100 or $200 a share. That was Facebook's sell-off, a record sell-off in the loss of a market cap. And coincidentally, Amazon was the record high for addition to market cap. The inverse, and I've talked to this, I'm going to remind you here, the inverse of the TQQQ, the T, which I just showed you, QQQ, which was $58, is if you think the NASDAQ will go up over time. The inverse is the SQQQ. That is a 3-time short on the NASDAQ. Come on, don't hide the information here on me. And let's take a quick look here on the 5-day chart. You can see as the NASDAQ went down, in part because of the sell-off of Facebook, look at how the SQQ bounced up. And so this goes up when the NASDAQ goes down, and that's what you're seeing here. I actually bought some SQQ this week, really using it somewhat as insurance to offset my TQQ. So I was hedging my portfolio that I had with the money I had in the TQQQ. I was hedging it by buying some SQQQ. So it went down, or the NASDAQ, I should say, went down, which is what caused this to go up. This is about when I bought it. I sold it for a slight gain and got out of it. Actually, this morning, I should have gotten out of it yesterday and just frankly forgot. When you buy the TQQ, you can hold it for, in my opinion, a long time, okay? Because what I just showed you, because of this, because markets will go up over time, okay? But when you buy the SQQQ, because markets don't go down permanently over time, you don't want to hold on to the SQQ very long. You want to watch the SQQ like you have your toddler swimming in a swimming pool. You want to be sitting right there, keeping your eye on it. And that's what I was doing. And frankly, as I said, I forgot yesterday. I shouldn't have. I would have made some more money. I got out today with a slight gain, but I was really buying it because I was concerned about what might happen on some of these earnings we were going to get on the tech stocks. And so that's, again, a technique that you can hedge your bets. You've heard probably that before. You've heard of hedge funds. This is a way you can be your own hedge fund manager by buying the SQQQ, which is going to move in an inverse relationship to the NASDAQ. When the NASDAQ goes down, this will go up in value. When the NASDAQ goes up in value, this will lose value. And as you see in the red today, closed at 38.55, down at $1.41 or 3.5%. I think that is pretty much what I wanted to talk to you about today. As we go forward, in mode, which I've mentioned, is going to be reporting on February 10. I did mention that. And the other thing I would keep an eye on is ZYXI, which has really been a disappointment. So I'm not necessarily telling you that this is a strong buy. I would say it is a buy that could give you a good return if you're willing to take some risk. Frankly, I never expected it to be down here below $8. You can see if we look over a 6-month period how far it has fallen. Going back to August, we were at $13.44. As recently as November, middle of November, we were at $13 and change, $13.64. So if you got this at $7.52, if you think you can put some risk money into this, if you go back to where we were in the middle of November, and it could go higher, is why I think I first brought it up when it was at about $15 or $16, thinking that it would go much higher. So at $7.52, I think on a risk-reward relationship, I think this is worth the risk for your risk money. If you're not in the mood to be taking much risk, then don't. But I think this is something, and we're going to be getting its fourth quarter earnings coming up, I believe the fourth quarter, before too long. Let me take myself out. I want to show you as we go down here on the right side. This is on Yahoo Finance I'm looking at. You can see where the last 2 quarters they beat earnings and they met earnings earlier, back whenever that was, March, I think. So it's, it is what it is, folks. There are no perfect plays. You just got to sometimes take your chances. And who would have thought that Facebook would have fallen out like it did, because they didn't pre-warn. So even on big names, and this is, I guess, where I'll conclude. Sometimes your stockbrokers and other people will put you in big names and they say, oh, you don't want to go into these small cap stocks. There's different ways to play the market. And I think the safe way are these indexes, the ETFs. I like the leverage indexes, as I've talked about. There are other ETFs. I think that going forward, we're still going to get a bounce on the oils. I think are still good. Oil now is at about $92 a barrel, I believe. At least it was earlier today. Let me take a quick look at DIG, which we've talked about before. That's a 2 times leveraged index on the oils. Of course, you got to be a little careful here because it's gone up quite a lot. If we look at 1 year, you can see how the value has gone up. It's not been a good play over 5 years because oil prices had gone down so much. But since the COVID, actually since about the fall of 2020, and that's the fallout here where I'm pointing right at March of 2020. But it went down further. And then when we got to the fall of 2020, and this right about here is where I started telling people to buy it. It was then $35 a share. It split 2 for 1. So when you see that 100 and let's call it $14 in the upper left, if you adjust for the split it did, it would have been the equivalent. When I was saying buy it at 35, that would have been the equivalent price of $228. So you can get some big moves here. Some of these, though, you just got to look. You got to look and watch them and have a feel. As I say, as I started this, what could go wrong in politics, what could go right. You got to have a feel for the whole outside world. Again, why we call it Money in Politics. Anyway, it's a Friday. The snow here has ended. I hope that you have had a safe and pleasurable week. If I can corner Thomas sometime soon, I will, and we can do another interview with him. And I look to do some other interviews, hopefully, with some of the people out there in investment land, which I haven't done recently. Have a great weekend, everyone. We'll see you again very shortly.